Hello, everyone, and welcome back to Perfect Spiral Capital. My name is Luke Tatum. I'm an authorized infinite banking practitioner. Today, I want to talk about the idea that the best possible whole life policy is one that has a very small base policy and a very high PUA rider. If you don't know what those terms mean, this may not be the best starting point video for you, but we will cover each thing briefly as we progress through the video here. So let's just say that there are three major components in what you might call an IBC style whole life policy. You're going to have your base policy, which is just a simple whole life insurance contract. You say, I would like a $500,000 death benefit, for example, and there is a guaranteed stream of payments over a guaranteed length of time that you must make in order to pay for that death benefit. Nothing fancy about it, doesn't vary. That's it. On top of the base policy, generally we're going to be adding one or two additional riders to that to make it more of an IBC style policy. The first rider would be a term insurance rider. Term insurance rider is just a term policy attached to the base policy. In other words, you have a $500,000 death benefit base policy. You might attach a $100,000 term rider. The term rider will be for a specific length of time. Let's say it's 30 years. So for 30 years, the first 30 years of your whole life policy, you would have an additional premium that would be due at the same time that your whole life premiums are due. And that is to increase the death benefit a certain amount. As to why you would put it on there, we'll talk more about that as the video goes on. The last component would be the paid up additions rider. Paid up additions are the chief way that IBC policies bring cash value into the present. In other words, if you pay a premium into the paid up additions rider, almost all of that will convert into cash value that's available to redeploy for some other purpose via policy loans. We have other videos on policy loans. Please be sure to check those out. So there is a popular idea out there. You'll see this particularly on social media, TikTok, things like that, where people are trying to show you the absolute highest amount of cash value in the very first year of a policy. And typically these videos don't tend to show you year 20, 30, 50, 75, etc. in a policy. They are very focused on giving you an extremely high cash value at the very beginning. Now you may think, doesn't that sound good? Don't I want the absolute highest cash value in the very first year? There's something to say for that. But there are negative repercussions of this move that will become evident later in life. You always have to be cognizant of this idea of a modified endowment contract, or MEC. The MEC is what we'll call it, just for shorthand, because modified endowment contract is a mouthful. So what is a MEC? Well, a modified endowment contract, to use the simplest possible terms, it's just saying that you have accumulated too much cash value inside of a policy too quickly. It's a lot more to it than that. But if you're building up cash value too quickly inside of a policy, you will lose the favorable tax treatment of your life insurance contract. If that occurs, then your policy loans will become taxable. There's various other problems that come along with that. And so you don't really want that. You shouldn't be setting out with a MEC design from the outset. So this idea that you should have a very small required base premium and a very high optional not required premium in the form of paid up additions. What are the problems with that? Well, there's several. One of the problems is that these policies are extremely MEC sensitive. In other words, changes in future dividend rates, changes in your PUA payments from what's shown on your original illustration, very small modifications to this plan that you laid out potentially 40, 50, 60 years ago can cause significant problems, and it can lead to you having to partially surrender your policy. It could lead to you being stuck with something that is going to become a modified endowment contract. I like to think of whole life, and this is not a perfect analogy, but I like to think of it as a funnel. A funnel starts wide and it tapers and then it straightens out in just a basic funnel shape. Well, at the top, let's say this is year one, the very, very top portion. Year one, you have a lot of room to pay paid up additions. Year two, you have slightly less. Year three, you have slightly less, etc. And then when your term rider has expired, when you've already paid a lot of paid up additions, you're going to get down to the point where it depends on the size of your base policy. Every company works a little differently. There's nuances to be found, definitely, when you're talking about policy design. It's highly individualized. This is why you need to work with a qualified professional that's done this a few times. But the general idea is you're going to reach a point where all you have left preventing the MEC status, the modified endowment contract status that you want to avoid, is the base policy. So if your base policy is extremely small, you may be walking on a razor's edge, and the slightest deviation could cause a modified endowment contract. So that's one problem. Number two, base policy and the paid up addition premiums that you've paid earn dividends differently. They are not the same thing. Your base policy will build cash value slowly. The cash value in a policy is the net present value of the death benefit that you signed up for on day one. So it's going to build slowly. However, it's going to build more. It's going to compound more than the premiums that you pay into your paid up additions rider. Paid up additions become cash value very quickly. Let's say, for the sake of argument, that you put in $1,000 into your paid up additions rider, and 95% of that is available as cash value right away. Cool. That's $950. That's great. It's not 100%, but it's great. After that paid up addition earns dividends for 1 or 2 or 3 years, you'll have more than $1,000. It'll have a net gain on that paid up addition payment. However, it's going to be somewhat of a slow burn. It earns dividends, but to earn the same dividend that your base policy will earn, you'll have to put orders of magnitude more money into the policy as paid up additions. So if your goal is to have something to supplement your retirement, something to help you travel, things that you want to do in retirement later in life, then you may prefer to pay more base premium because it will yield a higher dividend, other things being equal. The next thing to consider is that I mentioned these are very MEC sensitive policy designs when you have a very small base policy. There's this illusion that it's very easy to get caught up in. When you're designing a policy, when you're working with a life insurance carrier's illustration software, you're going in and saying, okay, here's how much base policy we want. Here's how much PUA we want over what schedule. When you're playing with the numbers, when you're trying to sell something to someone, it's very, very easy to get wrapped up in this idea that the illustration is correct. The illustration is not correct. The first thing that I say to every single person that I work with when we do an illustration review is this is not real. Nothing, basically nothing on this illustration is true. The guaranteed premium schedule, that's correct. The guaranteed growth on the policy, that's correct if there's no dividend ever paid. But most of the information, when we're talking about the tabular detail, the page of the illustration that shows you what the guaranteed and non-guaranteed growth figures for this policy are. It's all wrong. The guaranteed column is wrong because as soon as the insurance company pays one dividend, if they are profitable for 1 year, all of the numbers on that table will be different because they can't take a dividend back after they've paid it to you. If they pay a dividend to your policy buys additional paid up additions using that dividend, your policy has grown. They can't make it smaller just by mandate. They're not allowed to do that. And so as soon as one dividend is paid, the guaranteed table is all wrong. It's going to be bigger permanently. The non-guaranteed column or columns, the non-guaranteed side of the illustration is also wrong. Why? Because it assumes that the dividend rate will be the same exact rate every single year for as long as you have this policy. That's not reality. Insurance companies may have the same dividend rate for 2 or 3 years in a row from time to time. As I record this, January 2024, dividend rates are on the rise. Both of our insurance carriers have declared increases in their dividend rates. All of our illustrations now look different. If the Federal Reserve were to cut interest rates and things were to become a little bit more conservative with respect to interest rates, then those figures could go down, right? It's not reality to look at the non-guaranteed column and say, this is what will happen in the future. Why does it matter? Well, because if you're walking the razor's edge, if your base policy is, let's say, 10% of your total premium per year, 5% of your total premium, then you have an extremely MEC sensitive policy. Slight fluctuations can break this thing, and you will not know what to do when you're 95 years old with a policy that you thought was okay, and now you're looking at a multi-million-dollar tax liability. It's not okay. The way that you combat this is to have a larger base policy. And it has other advantages too, as we discussed. There are plenty of policies that come out of our office that are 50% base policy and 50% PUA. And do you know why? It's because our clients ask for that, because we talk about all of the reasons why different things go the way that they go. I'll run as many illustrations as someone wants to see. I've had people look at 30 or 40 illustrations before they've decided to apply for a policy. Those individuals are very detail oriented, and that's great. They have a very solid understanding of what they're getting into and why. They've made a very informed choice. Not everyone does that. That's okay too. But there's a bare minimum amount of understanding that we, as practitioners, as life insurance agents, we have a responsibility to communicate to our clients to make sure that they know what they're buying. I've gotten into a little bit of a back and forth with a few people in the past about these very, very small base policy designs, what some people would call an anti-base policy design. And I'll just say to, this individual that I'm working with at the time, I'll just say, hey, there are people who will give you a policy like this. It's not me. Because I don't want you to have that nasty surprise late in life. If this is something that you've maybe been looking at with someone out there, you have an agent, you have a policy like this, it's really important to look into this and to question it and to see what the pros and the cons are and kind of see where you stand. I've seen all kinds of just disasters come across my desk when it comes to life insurance designs. It's not my place to tell someone to get rid of a policy they already have. I don't like doing that. I don't like replacing life insurance policies. But it is my place when I see something to explain what the problems, potential pitfalls are, because my goal with this entire business is to help people have a financially literate interaction with the world around them. If this is something that's on your mind, if you have concerns about a policy you've got, if you have concerns about a policy you're thinking about setting up, please reach out. All of our agents on the team are more than happy to talk to you about this. Please reach out to them, set up a meeting with them. I'll personally get involved with all those conversations too, as needed, to ensure that we're giving the best possible information to everyone that reaches out. In the meantime, if you have some independent study that you'd like to do, please check the description box below. I have a book on the topic of finances, on the topic of financial freedom, and on the topic of infinite banking. It's called Between the Lies: How to Reclaim Your Future from the Banks and Wall Street. You can find it on print, digital, and audiobook narrated by me. That's all available in the description box. Thanks so much for watching, and I'll see you in the next video.